Hey everyone, welcome back to another edition of Super Prime UK with your Super Prime valuation specialist, myself, Rob Cohen.
And myself, James Wild.
Great to have you back. We haven't done the show together for a few weeks. We have been traveling around Europe, working and taking advantage of the holidays at the same time. So it's great to be together. And with the pound weakening massively against the dollar and the euro, maybe the traveling will be less regular as it becomes more and more challenging to do those overseas trips. James.
Thanks, Rob. So I wanted to get straight into the data this week. So obviously we've obviously had the Jubilee bank holidays, Rob. So we had a full week last week, and now on the back of that, another full week. So the new instructions have recovered somewhat. 361 this week, which is just above average for what we've seen so far this year in 2022. Rob, one thing we're seeing slightly more of is slightly increased price reductions week on week. So, just under 200 price reductions this week in terms of the instructions which are on the market. So, possibly some more motivated sellers out there, and some of that sort of market cooling spreading through the market, and people have a little bit more awareness that is going on. Fairly good pipeline, 194 properties under offer this week, whilst the sold figures are 135, so that figure being around average. We had a small drop off obviously last week on the back of the shorter week over the Jubilee bank holiday celebrations. So that's sort of where we are with the data, and as we said, Rob, the market remains fairly robust and continues to trade and function despite some cooling and some of the fiscal and economic issues which we've seen creeping in.
Yeah, and we're going to go into more detail in relation to the fiscal and economic conditions. I just think it's really important to share with everyone watching, listening, is that the uncertainty and volatility that we're seeing currently in both macroeconomic conditions and the data and information that we're being fed literally on a daily basis is creating and feeding that uncertainty and volatility, which leaves us in the position with so many contrasting and various views and opinions and triggers that are taking place, which is why to keep track of all of those on a continuous weekly basis, which is what we're trying to provide you, it is so important. I think we're going to go into a bit more detail on some of that.
Yeah, thanks, Rob. So in terms of the, just want to talk firstly about the economy overseas in the US. That's obviously going through a similar sort of issues that we're seeing in the UK, with obviously inflation and then trying to increase interest rates as a result of that. So sort of markets in the US are pricing in for around a 50 to 75 basis point rise on their Federal Reserve, which is broadly the equivalent to the UK base rate over here. The US and the UK, Rob, the UK often sort of follows suit and somewhat mimics some of the US sort of market and economic activities. And whilst that being said, obviously later today we could have a further interest rate rise in the UK by another 0.25%. So not quite the same extremes as the US are deciding upon, but obviously that's going to have some impact on the UK economy. Obviously the Bank of England were discussing inflation in quite a lot of detail, Rob, back in May, following the 40-year high of inflation at 9%. And they have quite openly commented that they will continue to gradually raise interest rates, and they're looking to get that figure, that UK base rate, to about 2.5% by mid-2023. And obviously if they're going to do that smoothly and gradually, we're going to see almost quarterly interest rate rises. So they're almost sort of building that in as sort of quite predictable. They don't want to shock the economy and shock the market. But what's your take on that, Rob? I mean, any other sort of impacts on the market there?
It's fascinating to see how the Bank of England, the Federal Reserve and the ECB are managing the interest rate hikes. I would say without question that the US are the most aggressive and the first to make those moves and the fastest. The UK following that trend with less aggression, and without question, the European Central Bank is lagging. So it will be interesting to see over the next 3, 6, 12 months whether one policymaker was right or wrong, and how that translates into the management or the controlling of inflation, which is the main intention for those interest rate triggers.
That's it. I mean, inflation is a global issue for all leading global market economies, and I think what all the central banks are trying to do is dampen the inflation without triggering a recession. And obviously, there has been sort of warnings by the Bank of England here towards the latter end of 2022 that we could see at least one negative quarter of negative growth here in the UK, and they obviously don't want to quite tip us over the edge into the recession, which would be 2 consecutive negative quarters of growth. So I think, Rob, we're finally balanced on that point, and we're going to have to wait and see what happens in obviously Q3 2022. I just wanted to do a quick sort of SWOT analysis, if you like, of the fiscal and economic conditions as we find them here in the UK. And just to sort of kick us off, obviously, we've spoken about it already, but inflation, obviously fuel prices and food within that. And obviously the sort of flip side of that, Rob, we've got the robust housing market where prices are increasing, and obviously construction, the housing property sector makes up such a large portion of the GDP that there is some sort of offsetting there in terms of those growth in those sectors. The main issue just being that sort of affordability gap and whether wage growth can quite keep pace with the rate that house prices are increasing. Just another analytical point on that, Rob. Nationwide, continue to report double-digit growth at the start of the month. It could be the last month we see of the double-digit growth, Rob. What do you think about that?
I think the interesting aspect of economic conditions is the robustness of the housing market. The demand and supply equilibrium in the UK has allowed for those price increases to happen and to be seen at the rates that we're discussing. Whether that's sustainable for a further period of time, I would agree that it will definitely see a softening and a cooling, because double-digit continuous growth isn't sustainable. At the same time, where you've got further support and help from the government with the further advances on the Help to Buy scheme, the UK government do want to drive the economy through the housing market, and they will do everything they can to support it the best way possible. So I think it's just going to be interesting to see how fiscal policy and economic conditions affect what is a strong property market.
Yeah, so possibly a new right to buy scheme which might be coming in. So just in terms of some other sort of overarching fiscal and economics, we've obviously got the interest rate rises as we've been discussing. And on the flip side of that, economic growth is still remaining positive for the time being, although it's sort of a quite low level, sort of minimal growth point. So at the minute, I think the economy is in a good position in terms of getting interest rates back to a more sort of sustainable level, whilst continuing at the moment of having that positive GDP growth. In terms of the labour market, it's a constrained labour market at the moment. A lot of people have exited the labour market as a result of COVID, starting to re-enter the job market now. But on the flip side of that, Rob, we've got almost record low unemployment, which I think is a positive for the country. And obviously job vacancies are very high, which is again that sort of full cycle effect of job vacancies versus low unemployment versus the constrained labour market has caused some issues in a lot of hospitality sectors and on the high street, especially people having some staffing issues there. And just lastly, in terms of the sort of constraints of the fiscal economics is the sort of wage demands and some of the wage growth, and obviously trying to keep pace with the housing market. Those are sort of inherently linked, and against that, obviously the construction sector, getting back to what it was in terms of delivery of houses, and something which almost propped up the economy during the pandemic, and something that really sort of kept the economy afloat, that sort of multiplier effect throughout.
Yeah, again, government backing and supporting right to buy, or all aspects of support within the housing and construction industry, is a key driver to the economy, and it's imperative that the confidence and the sentiment is good in the sector for that to continue.
Definitely. And just some further data, Rob, in terms of we spoke about the US and their sort of issues in terms of their economy. Their sort of property market has again had a real bounce the last couple of years. But in terms of the mortgage applications in the US, they're about 50% down at this current moment as compared to 12 months ago. So slightly more rapid cooling in their sort of residential property market as compared to what we've seen in the UK here. But what I would say, the UK property market, it's continuing to function and trades here in London, and both on a sort of national level. And however, buyers in the market, Rob, they're no longer drastically outnumbering the amount of available properties which we're seeing on the market. And as a result of this, many of these sort of slightly inflated asking prices are being adjusted to facilitate sales of those properties. As we said earlier, some more motivated vendors which don't want their sort of property just sat on the market. They're more motivated in terms of trading and moving on. With the supply shortage no longer fueling the market as it previously was. I know we've sort of said Nationwide did report their double-digit growth again for the previous month, but I think that is going to tip below the 10% mark next month, and that's going to be, I sort of predicting that's going to be sort of winding down, but it's going to remain sort of positive growth for the remainder of the year, but at a far more sustainable level.
Yeah, I think that following the US market and those trends is always a lead indicator. At the same time, the UK market is very standalone for the reasons that we've discussed, in the sense that maybe the US has a 1 million, 2 million property housing stock to be sold off and filled, whereas the UK faces the opposite challenge, that it never has enough supply and enough stock to be sold, which allows pricing to be at a certain level. So I think although the trends are important and they do normally repeat across markets, I think you also have to understand the underlying makeup of those markets in different countries, to see what the full impact will look like on factors such as mortgage applications.
Yeah, thanks, Rob. And just in terms of some other property news and sector news, we did announce back in 2020, Rob, about John Lewis entering the build-to-rent market, and I think that is now coming through to fruition. They're actively seeking JV partners to build out some of their housing stock, having a real drive for this. They're targeting around 10,000 homes initially in their housing portfolio, and John Lewis, they've said themselves they're not looking to be just the owner and developer, but they also want to be the operator too, in this new arm to the business, diversifying themselves away from some of their department stores. The flats, Rob, they're going to be furnished and designed by the John Lewis own brands, soft furnishings, having offerings for both short-term and longer-term tenants. So, they're going to have the market sort of fairly covered there. And looking more strategically at where they're planning some of their sites, it's all along the Elizabeth line, some in Ealing, further out towards the sort of Maidenhead branches, Reading. They really are targeting those sort of almost follows trend really, the race for space further out of London, but with really good links transport-wise for accessibility to London. So I think they've really got their sort of finger on the pulse there in terms of their market research and what people are wanting, especially in that rental sector. So that will be something which is coming over the next 2, 3, 4, 5 years to get up to 10,000 units. It's going to not going to happen overnight, but it's something that they're building into their business, and it's a new arm to their sector.
Yeah, we discussed on last week's show Abbey Wood being one of the key stations where house prices and property has increased the most over the last few years, purely for the reasons that you've just mentioned. I think the John Lewis model has huge potential, and if implemented correctly, as an operator and an owner and developer, I think it has a great opportunity. I said this 2 years ago when we discussed it then. If it can be implemented in the right locations, in the right areas with the right product, sounds like an absolutely brilliant business opportunity. And let's watch that space and see if then others will copy paste.
Yeah, possibly some marginal gains on their competitors there with sort of their homeware stores, furnishings, and sort of design layouts.
Absolutely. Close things up for this week, James. We are in a heat wave. The weather is good. Hopefully, following the Jubilee, there's a feel-good factor out there. Currencies are weak, which generally feeds into prime, super prime transactions by international buyers, so there's nothing they like better than a weak pound. As we've seen over the last 20 years, that's something that fuels prime, super prime. Just looking at the positives. And for all of the UK nationals or the people here that aren't travelling because of the currency position and the weak pound, let's hope the weather remains strong and good and we can take advantage of all the beauties and attractions that the UK offers.
That's it. Thanks very much, Rob.
Thanks, James. Thanks, everyone, for your amazing support, continued viewing and listening and questions across all the platforms, and the podcast goes from strength to strength, and it wouldn't be there without you. And whilst you're there, we're going to keep providing you with all the latest data, intel, and market updates of the property market and the financial lending markets that are built around that. So thank you for everyone. Super grateful. And we'll see you all next week.